Welcome back to the Dealist, your insider's guide to navigating the complex world of M&A. In the opening episode of Season 3, we heard an awful lot about how dealmakers are expecting deal structures to change over the course of 2026. And I have brought back Kevin Desai, partner at PwC, to help me have a conversation around how those deal structures are going to change. He's brought along with him Chris Rhodes, who's also a partner at PwC. Kevin and Chris, thank you so much to both of you for joining us today. Can I ask you for a few words of introduction, please? Kevin, you go first.
Absolutely. Thank you, Catherine. And thanks again for having me back. I'm happy to be here. And as you mentioned, I'm a partner at PwC. I've been doing work in our M&A and deals practice for the last 21 years. And I have the benefit of leading the team now as the leader of the deals business. But Chris, perhaps you can give a quick intro of yourself.
Perfect. Thank you. Yeah, Chris.
Yeah, hi. And thanks for having me on. My name is Chris. I'm a partner in our deals business, work across all of our private equity and I'll say deal structuring practice, and focus on any level of either complex capital raising or complex acquisitions or divestitures, which means that I spend most of my time working on larger private equity houses. So that's the bulk of my experience.
Super. Thank you very much. Now, as I said in the intro, when we started looking at what deal flow might look like over the course of 2026, we saw that there was an expectation that deal structures were going to change, that we were going to see a different way of transactions coming to the market. And when Kevin and I first spoke about it, he said, well, the person that you need to talk to is Chris, because Chris has observed exactly that. So Chris, tell us a little bit about what you're seeing at the moment when it comes to deal structures, and also why we're seeing these changes in the market.
Yeah, so I think the macro trend that always helps people to leg into this is there's a chart of these deals against a 15-year chart of U.S. Treasury rates. So I would say for about 12 or 13 years, U.S. Treasuries were really low, borrowing costs were low, and public debt markets were really liquid. So everybody had access to capital. About 4 years ago, that tightened up. You can obviously watch the treasury rates rise as well as credit spreads rising, and then I'll say private bond markets and 144A markets get a little more complicated. So if you take a company's capital table, large corporate capital table, and you say for 15 years it had the almost infinite access to unlimited debt and public equity, it had access to all the capital it needed, and now that's less the case. And so what we're finding is that the capital table has gone from just debt and equity to now debt at the top, equity at the bottom, and then something creative in the middle. And then at the same time, and I think the investment banks observe this trend as well, and have some stuff out that notes this transition. At the exact same time, the larger private equity houses have all gone and got themselves access to insurance capital. So the banks will sometimes refer to this as insurance capital, but the concept here is that the larger life insurance companies have very long holding periods for their investments, and they need to put that money to work for, say, 20 to 30 years. And the private equity shops figured out that was very good, what they like to call long-term patient or tailored capital. And so when you take the supply and the demand, on the supply side, there's all this insurance capital to deploy, and there's very creative providers, and there's people that all the cheap debt came due and they needed to find a new source of capital, and they have met each other in the market. And in the last 3 or 4 years, there's been, by our count, for just one version of this structure, we'll call it an on-balance sheet equity classified capital raise, there's probably 60 plus deals at well over 100 billion raised in terms of, in almost every industry, of this sort of long dated patient tailored capital. So like that's the big macro trend. And then in terms of the secondary version of that is, now that the market's gotten somewhat used to that, there's now more corollary uses and more creative uses of that for, say, acquisition capital or divestiture source of funding or pre-IPO sources of funding. So it's finding its way into what I think your listeners will find is their frequent use cases, right? You buy a company, you sell a division, or you raise some public capital. All of this is viewed as a source of capital that can be tailored to their specific needs and bridge to those three types, very common types of M&A.
Okay, thank you very much. Now, Kevin, I'd like to bring you into the conversation because against this backdrop that Chris described very nicely, obviously the question that is always at the forefront of corporates' minds is, the starting question, we are a good owner for this business, but are we a great owner? And then from the private equity side, like, what are we doing with all these assets that have been on our books for quite a while? Can you provide a little bit of color around how that is factoring into these conversations around deal structures?
Absolutely. I like how you framed it with the corporate question. Are we a good owner? Are we the right owner? I think those are the fundamental questions that people should be asking yourself. How does the business sit within my structure, and why is it best valued within my structure? What do I bring? What's my secret sauce? I think one question you should also ask about that is do I have the capacity to make the best of the business and the best of the asset? That could be management time, that could be R&D dollars, that could be balance sheet capacity. And even if you believe that the company in question, or the business segment in question, or the product in question, the asset in question, fits into your strategy, if you don't have the time or the capital to prioritize it, corporates need to ask, am I the right owner in this moment? And am I the right owner in the long term? And what do I want to do in the middle? And what's nice about what Chris was speaking about is it allows us to think about really high quality assets and think about their financeability differently, to almost put some capital into a business that requires quite a bit to continue to grow and run, without it distracting management from the day-to-day of operating the rest of the business. And so those are the dynamics that we're thinking about from a corporate perspective, is high quality assets with a long runway to grow, but perhaps needs a special amount of attention, either capital or managerial attention, right? Private equity likes this because it can become a very tailored and highly structured transaction with a very clear purpose of what their role is. Private equity is always good at deploying capital against a need. And when the need can be articulated clearly, then you put governance around it. You could put returns around it, set IRRs, a call option or a put option at the end. So the asset and the owner can be reunited. There's a lot of creative structuring that happens that enables a really strong business purpose. And that's where we really like to focus.
Okay. One thing that I just wanted to dig a tiny little bit deeper that you said, this sort of conversation around, am I the right owner for this business right now and in the future? But is it fair to say that given the situation that Chris has described about how the financing environment has changed, that question, had you asked it 5 years ago, and you might have said, actually, yeah, I think we are the right owner for the business right now. If you ask the same question of the same asset now, the answer might be quite different.
That's exactly right, especially when you think about the financial needs to fund the growth profile that you're talking about. In years past, when debt was a little bit cheaper, a little bit more available in more traditional senses, you could find the financial wherewithal to invest behind, frankly, a lot of ideas. I think in today's world where things are a little bit tighter, there's more scrutiny placed on the folks' balance sheets. These alternative structures really allow you to access the capital markets, both equity and debt, in more unique ways that effectively bring down your borrowing cost than what would be otherwise available to you.
Okay, thank you very much. Now, Chris, I'd like to bring you back into the conversation. Going with this hypothetical scenario that Kevin has described just now, we're having the conversation, this is a great asset, but we are no longer the right owner for it. Or in the case of the private equity fund, we've had this wonderful asset on our books a very long time, but it needs to leave us. We need to part company. What are the options that are available to players out there at the moment? I'm thinking from a creative deal structuring point of view. What can they do with those businesses?
Right. So let's take each of them in turn. I would say if you look at some of the traditional monoline private equity, traditional leverage buyouts, that a lot of them are, this is all over the press, right? That a lot of them are maturing in their funds and they're looking for exits. And there's a lot of press around continuation funds, which is one way to do it, right? You take it out of the main group of fund holders and you put it into a vehicle, and it's a continuation fund, right? And they can continue to hold it. The other one is that we're seeing a lot of discussions on across all the houses is, can I sell this portfolio company but retain an ongoing interest because of where it is in the cycle? I think there's some upside. I need some liquidity, but I think there's some upside. The first order of business is a continuation fund. I can just continue to hold it and be the equity owner. I can sell it to somebody that can help me realize the deal thesis, whether it's a strategic or somebody, or even another house sometimes, and retain partial ownership. Or I can help even finance the partial sale of it to someone else by having sort of a very elaborate seller financing from the private equity shop that's more akin to this, I'll call it this mezzanine long-term capital, and say, you only have to pay for half of this up front, and then we can work out whether you buy the other half later or whether we stay partnered, right? But I can show liquidity for my current fund. And then, so that's on the fund side. On the corporate side, it's literally the same. I really like this division. It's been my favorite for a long time. It's a fairly stable, mature division, and I really love it. And it would be easy to capitalize, but right now the equity analysts are kind of pushing on me to either realize this thing or I've got an activist shareholder that says, let's liquidate this thing and get a special dividend going. But I don't want to. It's my favorite. And it's a really good, steady earner. You can finance it much more creatively now because it's a good, steady source of cash flows. You can finance it very specifically, and that handles a lot of situations for the broader corporate, and it becomes a really good source of income, whether it's sold and you lose control of it, or whether you retain full control of it on balance sheet. Either way, this sort of very stable long-term capital is a really good use against a stable set of assets.
Can you give me any examples of transactions that we've seen that sort of fit this description of yours?
Yeah, so in the market for these, in the on-balance sheet category, right, there's chip manufacturers do it with new production plants, music and entertainment, they put some fairly evergreen music libraries into one of these, very stable cash flows, cool classic rock bands that everybody would know the name of and still downloads. There's airplane engines, there's midstream oil pipelines, and now very recently in the news, a coffee company putting coffee production into one of these things. So generally it can be almost any asset class. The characteristic that you can imagine private capital would be looking for is a stable set of cash flows, a fairly stable, established business. It's not speculative biotech or R&D focused, but it's a fairly stable, mature business, because it's much easier to finance that with equity financing that's stable and mature and a lower cost of capital.
It's really interesting because, the sectors that you described, they are really, really diverse. And I think it's worth keeping that in mind, that this is not necessarily a play that only works for, say, the tech industry. It's actually something that is applicable, because if you think about coffee, you think about tech, you think about music libraries. Those are really, really different things. So thanks for sharing those examples. Kevin, let me bring you in. Talk to me about the conversations that you're having with clients about this. How much enthusiasm, how much appetite are you seeing from them to go down this route? Is it something that you come across in your daily conversations?
Absolutely. I think from both the corporate and a private equity side, this is something that is coming up more and more frequently. I think as more of these transactions hit the news cycle, people want to understand what it is, what it isn't, what is the strategic purpose of the transaction. So there's folks who are on that side of the spectrum. And then, as Chris has mentioned, the larger asset managers, especially those with a larger source of permanent capital or the insurance portfolio, are really thinking strategically about their own sources of capital and how to deploy it against the duration risk that they're trying to control. And so they're probably leading the way. And the question is, how do we marry those who have the capital with those who have the interest? And that's where the conversations have been tending. It's like, well, where in my portfolio do you see assets that fit this mold? That is a conversation we're having more and more of every day.
Okay, super. Thank you very much. Chris, I'd like to come back to you and pick your brain on private equity in a little bit more detail. You spoke a little bit already about some of the pressures that private equity funds are facing. We spoke about evergreen funds that they are moving assets into. Can you just provide a little bit more color and depth around this conversation of the pressures that the private equity industry is facing at the moment?
Yeah, I think just as an outside observer, I think what's interesting is that the pressures are unrelated but very similar that the corporates are facing, right? It's, we've gone through a part of the cycle where private equity is tending to hold portfolio companies for longer. Either they can't get the exit value they're looking for, they can't find the right window to divest or whatever it may be. And rather than give it up at a bad price, they're pretty proud of what they've done with it and very happy with what they've done with it, and they want to get the right price and they need to hold it for longer, but they're under tremendous pressure. You can see all over the news where private equity has formed new fund structures that allow for more immediate redemptions, that the redemptions come quickly sometimes. And in these longer dated funds where the redemptions are much more controlled, you nonetheless get investors calling you and saying, hey, my money's been tied up for 8-9 years. Come on. And private equity basically saying, yeah, but we have a lot of value that's trapped in here and we like it and we don't want to give it up. We don't want to sell it at a fire sale to give you the cash. Like, what's the trade-off between value and liquidity? And so there ends up being a discussion. And then if somebody says, well, I really value liquidity, they say, great. For those of you who are willing to continue holding, you're the candidates to put it into a continuation fund. But it ends up being that sliding scale. And it's the exact same thing, like Kevin was just saying, with the corporate. I have a really steady, mature business and I'm under pressure to monetize that, either an activist shareholder or just my overall balance sheet leverage ratios. I need to find a cheaper source of capital for one or the other, but it needs to feed some other strategic need. So, going back a couple minutes to what Kevin was saying, everything Kevin said, yes, plus one other element. So if Kevin said the trick here is to say that in this newer, less developed part of the market, there's a very large source of capital and it's trying to work its way through to find all the eligible use cases for the needs of that capital. The needs of that capital, when we start to have that conversation with the corporates, first, it's what's a collection of assets on your balance sheet that's a really good candidate for this source of capital? And then B, usually it's paired with what's the strategic next move that you feel constrained on, because you can't just go borrow in an unlimited way. What's the thing you're trying to accomplish that you can't just hit an easy button and get a few $1 billion to go do? So it's not only finding the eligible assets that would be a really good fit for this low cost of capital, it's also pairing it with a strategic need. So usually, say for example, you have a mature music library with much older artists, evergreen, it will always attract downloads, but you have a new up and coming artist and you really want to lock them down in a new long-term deal. You monetize the old stable asset to pay for the development of the new growth. So it's literally business school 101. You take your most mature business, you monetize it as efficiently as you can, and you take that capital and you put it into this speculative thing that you're the best in the world at. And if you're a music company, you're the best at finding and developing new artists. If you're an energy company, you might take the really stable pipeline proceeds and you might put it into alternative energy or some kind of new technology. If you have a mature drug portfolio that's really stable cash flows, you might put it into R&D for the next drug. It's finding that strategic use case of, I want to go acquire a target. I can't borrow to do it. What's the really big stable asset that I could monetize to then go get my growth targets met?
Great. Thank you very much. Let's take a quick break there and then come back to have a conversation around private capital.
Intralinks Deal Center AI, the smart choice for next generation deal making. The first intuitive platform for every deal phase. Powered by Link, our AI engine. To give you the edge. Work faster, securely. Tackle every deal pain point. Automate tedious tasks. Analyze critical insights. And maintain compliance with deal archives. Know you got the details right. Deal Center AI with Link makes every deal better than the last. With unrivaled control, performance, and results. Transform your deal making with Deal Center AI. Intralinks. Go forward.
Right. We said before the break that we'd have a talk around private capital. Chris, when we had our prep call, private capital came up quite frequently as one of the things that we need to be looking out for and that's going to play an increasingly important role. What is the role of private capital in the current financing environment?
The way I'm seeing it play out, and I see a lot of the market, but maybe not all of it, and it's unlimited creativity. But I think the first thing that I've learned, and I spent about a year speaking about it incorrectly and mixing it and commingling it with private credit. I think private credit is its own use case, and there's obviously originating loans and sourcing loans to companies, whether it's private or public, and the competition there. And then there's equity, public equity and private equity. And then I think private capital I would describe as in between. So it's basically in the mezzanine, right? It's mezzanine capital. It's generally below debt, but above equity, or it's some kind of senior class of equity. And it's generally, because it's private and long dated, it can be tailored to your specific case. Every company has a specific need, and they need it to be a little different. And that's very different than, say, a bond market that can price you at a 7-year maturity and knows exactly who are the likely investors. This is very different. You can deal with one investor and you can tailor something specifically to what you want, and they can price the capital for you. And sometimes if you want it done in a very specific way to you, that might cost you 50 more basis points, but that's still cheaper than you could get in the fairly standardized markets. So it's the ability to tailor it and the ability to meet your specific corporate needs.
Okay. Kevin, talk to me about how your clients feel when the topic comes to private capital, whether it's something that they're quite keen to engage with, whether it's something you take to them and they're like, we haven't even thought of that. Just share some of your experiences in that particular area of the financing environment.
Catherine, it's a great question. I think folks are more and more intrigued by the art of the possible, especially as more
That's
and
a lovely
more.
expression. The art of the possible. I love it. Fits with Chris's creativity, which has come up a number of times as well. Sorry, I interrupted you. Talk to me about the art of the possible.
No, yeah, from the art of the possible, it's you read a lot of press headlines about these structures more recently, especially with the advent of the investments into data centers. So I think, to your point, a lot of folks believe that these tools are only financing structures are only available to some subsectors of the economy and not thinking more broadly. So I think it usually starts with a conversation of, why is it that a data center provider can raise money in these creative ways and why can't I? It's, everybody does anchor, as Chris alluded to, that private capital equals private credit, and that is not exactly true. It is, they overlap, but they're not concentric circles. And so the conversations often start with what's happening in the data center market. And then it quickly pivots to, wait, I've got assets that are stable, nice growing, good cash flow profile, understandable, easy to digest. And then we move on to the strategic imperatives of that business and the adjacent businesses, kind of as Chris highlighted. It's putting it all together. But where the conversations honestly are obviously starting is, what is permanent capital? Why do private equity want to own insurance companies? And what's going on with data centers? Those are the main topics that drive the initial conversations.
Okay. To both of you, is there any sector that's particularly drawn to private capital, or is it something like we spoke about earlier that is actually applicable and attractive to all sectors? Chris, maybe you go first.
So I think with what Kevin just said, because there's so much focus on, I'll say, digital infrastructure and the build out for the AI boom, and the question of whether industrial manias are overbuilt, allegories to the railroads and things like that, right? So there's that entire sphere because whatever one of the recent estimates I read was 686 billion of capex to come in that center. So obviously, if capitalism is boiled down in its simplest terms to sources of capital and new ideas, data centers and digital infra is the first stop. But as Kevin rightly pointed out, that it's not built for that. It's not specific to that. It applies to any. It generally tends to be large strategic projects. So if you're sitting in a corporate strategy discussion and you have N+1 projects, that could either be very large capital expenditure, it could be expansion of an existing business, it could be the acquisition of a new business, but you're trying to basically look in your couch cushions and find all the money you can to pursue that N+1 project. And you can't make it work in the public debt and equity markets, and you're really struggling to get it as cheap as you want it to make that work. There's a source of capital. So this capital generally wants to fund any project that it views as sufficiently stable. And all the private equity shops think of it in terms of per units of risk, right? As long as you have a fairly stable N+1 project, whether that's acquire to consolidate in your industry sector, whether that is to build 2 new production plants, or whether that is to sign new artists or expand your business or spend on marketing, buy a bunch of Super Bowl ads, but it'll unlock your business, right? Whatever that strategic thing is you're looking to do, if you're financing something that's stable and steady, they can basically tell you the correct price of capital for that subset of your business, and they'll price it accordingly, and then everybody wins, right? So I think in general there are probably 3 sectors that are the heaviest right now, and they're all very large capex heavy, right? So there's energy and infra, and so building new pipelines, oil and gas in general is very large capex heavy, right? And it also has some very mature, stable cash flows. I think R&D and pharma is a pretty good use case, and I've seen a lot of digital infra. So I would say those are the biggest. It's large capex right now. What I'm seeing beginning in dialogues, and there's less publicly available deals for it, is large corporates across the board, all industries, that have, say, a mixture of divisions where one is more growth oriented and one is very mature. And the equity analysts, for whatever reason, are not as enamored with the mature division. And they're trying to figure out a way to either sell that or monetize it to pursue even more aggressive growth strategies. So it's a conglomerate or a large corporate of mixed businesses that is trying to figure out how to divest of a lower growth division. And we haven't seen a ton of the divestiture cases, but in terms of public that I could talk about, but in terms of the activity of what I'm talking about on a day-to-day basis, I think that's the new use case.
Okay, super. Popular. Great, thank you. Kevin, just a few words from your perspective of the industries where you think we will see the majority of use of private capital.
I think where Chris landed is where I would start. I think those are probably the right places that we're having the most active conversations. But I do think when we are looking at almost any large scale carve out, it is a question we're seeing more and more of, is that when we're trying to finance a carve out, what are the assets within the asset that's being carved out that we can finance differently? And that kind of spreads. We're seeing quite a bit of divestiture activity, as Chris mentioned, in the CPG space, not somewhere that we would have historically looked. But I think there are probably some really nice assets in the CPG space that would throw off sufficient cash flow to be thinking about differently. And so when we think about that, and whether it's music or CPG, there's this element of brand where these brands exist that are powerful, or probably something worth to dig into there.
Okay. Brilliant. Now, I'd like us to cast our eyes a little bit into the future and ask you, what are your expectations with regards to how this theme of creative deal structures is going to continue over the course of 2026 and into 2027? According to the H1 2026 Intralinks Dealmakers Sentiment Report, we'll link the report in the show notes at the bottom of this screen. 35% of our respondents anticipate involvement in some sort of joint venture or a strategic alliance. So there is definitely a sentiment out there that we're going to see more of these creative structures. Chris, crystal ball gazing time. Where do you think this is going to go? Is this something where we're just at the beginning of sort of an upward curve? Do you think this is sort of as active as it's going to get in that space? Just share some of your insights, please.
Absolutely. And I love that you asked me to explain how relevant I will be in front of my boss on a podcast.
Let's do that.
I do think, this is all joking aside, this is a debate we have a lot with the investment bankers, right? It's like, oh man, is this all going to go away soon because the debt and equity markets will get liquid again? And in terms of conversations with, I would say, the larger investment banks that are strategically involved in all this stuff, they're making bets too, and they're betting on it being a long-term trend, that there will be debt, there will be equity, and there will be tailored capital. And it will be fairly long-term. And as Kevin rightly put it, and drawing all of it together into one simple concept, private equity fund 6 needing to get liquidity is the same as large corporate that needs to monetize an asset, is the same as a company that wants to pursue strategic initiative X, but they need to venture with somebody. All of it is, we're going to share in the capital risk. And I think, and we need to get some liquidity for that. We need to get a source of capital that is much more tailored and sharing oriented. Traditionally, joint ventures is 2 complementary businesses coming together to realize the synergies of some complement together, right? I am R&D and you're sales, and together we will invent new things and sell them at a profit. And now we're finding that the source of capital itself, especially when it's connected to private equity, this is why we call it private capital and not private credit. There is some active involvement. It's similar to traditional private equity in that not only can you sell me this business, but I will venture with you. You'll have my capital, but I know how to show up to board meetings and add value and have some suggestions around new strategic initiatives. So it's a very partnering concept, especially for those corporates that have really held on to a division for a long time and it's really stable and it just needs to be spruced up a little bit. Traditionally, that would be a leverage buyout. I'll just sell it, wash my hands of it, and it will get sold on into the market. And now they can venture together and say, we're going to go together and we're going to hold it together for 4 or 5 years and transform the business. And then at the end, I'll either take it back, maybe, or we sell it together on into the market to the point you raised at the beginning, to whoever that owner is that has the highest and best use of this asset and therefore would pay top dollar for that asset. They have the absolute best use of it and can realize its full value. So I'm definitely seeing a lot of the, it really is as simple as it has evolved into a case for acquisitions, a lot of volume right now for discussions around divestitures, and then joint ventures, which are either partial versions of each. I buy into a 50-50 into a JV, or I sell down to a 50-50 in a JV. There's all 3 cases are really active. I'm spending all day, every day talking about all 3 of those.
Okay. So I think, Kevin, Chris has made his case. He's going to be very busy in the coming months and years. Do you agree with him?
I sure hope he's busy. That would be phenomenal, but I do agree with him. I want to pick up on 2 things he said. One is this concept of N+1. I really like this statement. There's a population of things that need to get done, and then there's probably one more that you're not thinking of, or one more that needs to absolutely happen. And then the case for change or transformation. I think that's really where, when I look at the crystal ball, I see the opportunity. In today's environment of change that we're feeling in every sector of the economy, especially as AI infiltrates and changes how we think, how we work, how we buy products, and creates a whole new industries in and of itself, we have to be thinking about, how do legacy sectors evolve? How do legacy businesses evolve? And that evolution, in some cases, will be straightforward, down the fairway, can be financed through the cash flows of the business, and it is fine. Like it is not a fundamental shift in the business. In others, we're going to see sector convergence in a big way, where tech is going to infiltrate healthcare and finance and insurance, and you go through. And when that infiltration happens, and as it will, the transformation can be expensive and it could be riskier. And this is a way to align incentives, de-risk the proposition, get people with that business building mindset alongside of a stable business to really push it into the new era. And so for me, I think it is a very strategic tool for corporates to be thinking about as they want to pivot their business models.
When it comes to exploring new and different deal structures, what's the one thing that your clients or other deal makers indeed need to keep in mind?
Thanks. Yeah, no, sorry for that. So I think for me, the biggest concept is that complexity and structuring is not necessarily to be feared. I think most people are the same. If there's a degree of familiarity with the way they've done it in the past, there's far less risk. But I actually view the risk as the opposite now. There's a little bit more risk to doing it the way you've always done it, just like Kevin described, right? Your business might be pivoting, your source of capital might be changing. My big takeaway is don't be afraid of where the money comes from. Make sure the money's right for your business and your deal. Now, some of these, that means ask the question, examine it, get smart, do the work, do the homework, learn the new thing, and then with confidence go to your board and say, this isn't right for us. Or more likely, you would say, this is absolutely right for us. But what I'm seeing out there is very good sources of capital, not being available to companies because they're a little fearful of the newness or the complexity. So I guess my tagline would be, don't be afraid of where the money comes from. Make sure it's right for you.
Super. That's very, very nice. Kevin, what about you? What's the one piece of advice that you think people should keep in mind?
I think governance rights matter, right? And it's like to the Chris's point of, is this the right source of capital for you? Is what does that capital come along with? How active a participation will the capital be? You want the thoughts, you want the ideas, you want the governance that will bring. So beyond just thinking about this as a financing exercise, thinking about it as a joint venture, as Catherine, as you put it, of how the two parties will work together to solve a problem and what will be the governance around it, that is paramount to actually getting the most value out of these structures.
Fantastic. Unfortunately, that's all that we have time for on today's episode of The Dealist, but I'd like to extend a huge thank you to both Chris and Kevin for sharing such wonderful insights into what deal structures are looking like and could look like in the future.
Catherine, thanks so much for having us. I really enjoyed the conversation today.
Great. Now, if you enjoyed this episode of The Dealist, please like, follow and subscribe, comment as well. We'd love to hear from you. Similarly, if you feel that you've got a great deal making story or an M&A topic that you'd like us to explore, please get in touch. The email address is at the bottom of the screen. That's all from us today. Thank you so much for listening. And until next time, goodbye.